Last tax season I got a check from the IRS for $8,000. Not because I cheated. Not because I hired some sketchy accountant. But because I learned exactly how the tax code works, and I'm going to show you every single step I took in this video. Welcome back to the channel. If you're new here, this is where we expose everything the IRS hopes you never figure out about your own money. Today's video is different. No quick tips. No listicles. I'm going to walk you through my complete tax breakdown, every credit, every deduction, every strategy I used to go from owing the IRS money to getting $8,000 back. And I promise you, most of what I'm about to share, your accountant has probably never mentioned it. First, let me set the scene so you understand this applies to regular people, not millionaires. Last year I was a W-2 employee making around $65,000 a year. I had student loans. I had a kid. I was contributing to my 401k. Pretty average American situation, right? My first tax estimate showed I was getting about $400 back, which felt fine. Until I started digging. 2 weeks and a lot of research later, that $400 refund turned into $8,000. Same income. Same job. Same life. Just knowing where to look. Here's exactly what I found. The first thing that changed everything was the Earned Income Tax Credit, also called the EIC. This is hands down the most valuable tax credit available to working Americans, and it is wildly underused. Here's how it works. If you worked and earned income below a certain threshold, the government gives you a refundable credit. Meaning even if you owe zero taxes, they still send you a check. For 2024 tax year the numbers look like this. I have one child. So right there, before anything else, I qualified for over $4,000. Now here's the part that blows people's minds. The IRS estimates that 1 in 5 eligible Americans never claims this credit. That's 20% of people literally giving away thousands of dollars every single year. Why? Because the eligibility rules look complicated at first glance. But let me break it down simple. Rule 1, you must have earned income from a job or self-employment. Rule 2, your investment income must be under $11,000. Rule 3, you must have a valid Social Security number. Rule 4, you must be a U.S. citizen or resident alien. Rule 5, income limits depend on filing status and number of kids. If you check those boxes, you need to be claiming this. Period. Credit number 2, and this stacked right on top of the EIC for me, was the child tax credit. If you have a child under 17, the government gives you up to $2,000 per child as a tax credit. And up to $1,600 of that is refundable. So let me do the math for you real quick. We're already at over $6,000, and I haven't even touched deductions yet. Now I know what you're thinking. I don't have kids, so this doesn't apply to me. Stay with me because the next ones definitely will. But for parents watching this, if you're not claiming both the EIC and the child tax credit together, you are leaving serious money behind. Pro tip: if you share custody of a child, talk to a tax professional about who claims the child each year. Alternating years can actually maximize the credit for both parents. Okay, now let's talk deductions. Because credits reduce your tax bill directly, but deductions reduce your taxable income. Both matter. Both add up. Deduction number 1, student loan interest. I paid about $2,200 in student loan interest last year. The IRS allows you to deduct up to $2,500 of that straight from your taxable income, even if you take the standard deduction. At my tax bracket, that saved me roughly $484 in taxes. Not huge on its own, but we're stacking here. Remember, you need your 1098E form from your loan servicer to claim this. Check your email or loan portal from January of this year. Now this next one, this is where things got really interesting for me. I was contributing 8% of my salary to my
401k. About $5,200 for the year. And I knew that reduced my taxable income, but I never really sat down and calculated what that actually meant in dollars. Here's the breakdown. Just by contributing to my 401k, which I was already doing, I saved over $1,100 in taxes. Money I was already saving for retirement, and the IRS was rewarding me for it. And here's the kicker, for 2024 you can contribute up to $23,000 to your 401k. If you're 50 or older, that goes up to $30,500. The more you contribute, the less the IRS can touch. At this point I was already shocked. But then I found one more credit I had completely forgotten about. The Savers Credit, also called the Retirement Savings Contributions Credit. Because I was contributing to my 401k and my income was under the threshold, I qualified for an additional credit worth 10% of my contributions. That's another $520 just for doing something I was already doing. $8,161. From a $400 estimated refund. Same income. Same job. Just knowing where to look. Now I want you to really sit with this for a second. Every single one of these credits and deductions, the IRS knew I qualified for them. They had my W-2. They had my 1098E. They had my 401k contribution records. But their system is not designed to help you. It is designed to collect. The burden of claiming every dollar you're owed falls entirely on you. And the most frustrating part? Most people just plug their numbers into TurboTax, click through without reading anything, and accept whatever number pops up. They have no idea they're walking away from thousands of dollars. So here's exactly what I want you to do after this video. Step 1. Pull up your last tax return right now. Look at what credits you claimed. If 8, Child Tax Credit, and Savers Credit are not on there, you need to investigate. Step 2. Find your 1098E form for student loan interest. It should be in your email or your loan servicer portal from last January. Step 3. Check your 401k contribution total for the year. Your HR portal or year-end statement will have this. Step 4. If you filed already and missed these, file an amended return using Form 1040X. You have 3 years to go back and claim missed credits. That means you can potentially claim missed credits from 2021, 2022, and 2023 right now. Step 5. If this feels overwhelming, use a CPA, not just tax software. A good CPA will find credits software misses. The cost is worth it. And before I let you go, 3 bonus tips that took my refund even further. Bonus tip 1. If you worked from home even part-time and you're self-employed, you can deduct a portion of your rent, utilities and internet as a home office deduction. Bonus tip 2. Charitable donations are deductible. Even non-cash donations like clothes to Goodwill. Keep your receipts. Bonus tip 3. Medical expenses that exceed 7.5% of your adjusted gross income are deductible. If you had a big medical year, don't overlook this one. If this video just opened your eyes, hit that subscribe button right now because every single week I'm dropping videos like this. Tax secrets. Money hacks. IRS strategies that your accountant charges hundreds of dollars to explain. Drop a comment below and tell me, what was your biggest tax refund ever? I read every single comment. And share this with one person in your life who you know is overpaying the IRS. You might literally be saving them thousands of dollars. The tax code is 70,000 pages long. The IRS has armies of people who understand every single word of it. The only weapon you have against that system is knowledge. And now you have a little more of it. I'll see you in the next one.